So welcome to everyone. You're at the right place at the right moment. So we wait some seconds and minutes to wait that people are joining. As you know, you are here for the bi-weekly or monthly, according to the month, webinar from the Green, Inclusive and Climate Smart Finance Action Group. Let's give 1 or 2 minutes to people to join. Welcome to everyone. So welcome to people that are joining still. As you know, the webinar is registered, so you will be able also to have access to it on the webinar webpage of the Green, Inclusive and Climate Smart Finance Action Group, as well as you will find later there the slide of the presentation. So in case some of your colleagues could not attend, just be free to address them to the webpage. I just take another minute and then we start. So while we start, I remind to everyone that you can interact with us in the chat that you should find on the top or the bottom of your Zoom screen, as well as in the question and answer that you find nearby. So please clearly feel free to write us there. We're going to take extensive set of question and answer to discuss together and to work together on the topic of green inclusive finance, specifically for adaptation in agriculture today. Yeah, don't be shy. Please put your question, your doubt, as well as share your experience. So let us slowly start to dive into today's webinar. So today we are extremely lucky to have Mark with us. So as probably some of you know, Mark is part of the member of the Green, Inclusive and Climate Smart Finance Action Group from IFAD, so a leading entity for the financing of agriculture worldwide and for developing best practices in agriculture. And he's going to tell us about inclusive green finance, global trends and good practices from recent experience in project design, as well as in implementation. So before going into that, I take the word for a couple of minutes for the newer coming. You can, of course, post from which institution you are, as well as from which country you are into the chat, or rename yourself to make that clear into your name, to put your name of institution or your country. That some faces apparently are new, some we know very well, so that's we can better interact. Voila, before going to that, some people maybe join us for the first time. So this is one of the webinar of the Green, Inclusive and Climate Smart Finance Action Group. So we have been there for a while. So is a group, is an action group that is hosted by the European Microfinance Platform and as a clear mandate. So our clear mandate is to basically support the establishment of a unique multi-stakeholder think tank that is the action group that is built by their own members and by their will to get more and more engaged into green inclusive finance by mainly discussing current challenging strategies. So what did we do what we should do and what are the challenges we're encountering by doing that, improve the knowledge as a sector, as well as the action. As many one of you knows, 2030 is basically tomorrow, so we need to move toward actions. And of course, enhance cooperation, increase international attention on the topic, as well as develop dedicated tools. We'll say 2 words on that in a moment. Tools to act that can enable our action. And once we do what we are supposed to do as a sector, then support the sharing of knowledge, know-how, and finding, as well as, of course, enhance through our action the commitment and interest of other parties. So we has been founded quite some time ago, actually almost 9 years ago. And as of today, the number of members is around 150 or more, representing more than 70 institutions. You can see a list here. So Natalia Real Pecarillo from EDERA and EISS from Potsdam and myself are coordinating the group since a while, and it's our great honor. What is unique is that it's really is a mix of private and public, consulting, IT investors, and any kind of institution, network of financial institution that is interested into this transition. So if you want to know more, please don't be shy, visit our webpage. It's here on this slide, and here you see various of the things we do. So you can click in any one of these boxes and discover some of the products, the trainings, the publication, etc. In particular, we very much advise everyone to visit the webpage that you see here. Is about the Green Index. So the Green Index, as you maybe know, has been there for more than 6 years, actually I think 7 years as of today. And we recently released the version 3.0 as a tool to assess the environmental performance of financial institutions, specifically microfinance, but also local banks, cooperatives, and to support them in their growth into the engagement and action in green inclusive finance. Together with SPTF and SERIS, where we could develop the new dimension of the Universal Standard for Social and Environmental Performance, that is the Environmental Performance Standard. So please visit that. You can find also a specific online tool, that is a digital tool that has been designed for us by EDERA and has been conceptualized and implemented by the Action Group, that provide free access to everyone who want to use the Green Index 3.0 to self-assess or to have an assessment with experts for their environmental engagement and possibly plan to implement the action needed to improve. If you want to know more about information knowledge in the green inclusive finance, you should find there in our website as well an online library that is an ongoing effort. So we try to put there publicly available and for free for everyone documents that could be academic or gray literature, specifically for green inclusive finance. So please look there for topic. And if you see something missing, some publication that you think should be there, just drop us an email and we'll be very happy to include the publication you will advise us to include there. If you want to see the previous experience, other experience worldwide, as well as the record of this webinar, there is a website, I said, a webpage, sorry, on our website on the webinars. So there you find the records and you find the material are freely and publicly available to everyone. You will find the same one, the same of the present one, you will find there as well. Recently, we have been released a training. Again, our mandate is to provide as much as freely available material. So this is an extensive training on 7 modules on green inclusive finance, from strategy to actual products, as well as you see at the bottom, section 7 and 6 on interlinkages within gender as well as digitalization about green inclusive finance. So it's around, I don't remember the number of pages, but 300, 400 or more pages slide organized in various subsections. So you please can go there and get trained or ask us to receive a training. Voila, so that is just for introduction. Now let me go back to the key topic of today. As said, we are extremely glad to have Mark here. Mark is from IFAD and is a lead specialist at the regional level on rural finance and markets. And today is going to tell us about inclusive green finance and what do we see in IFAD as a global trend and good practices. Mark, we are happy to welcome you, and the floor is yours.
Thank you, David. It's a pleasure to be here and to speak with you all, and I hope we can have an interesting question and answer period at the end. As most of you know, IFAD is the International Fund for Agricultural Development, and we got our start in the late 70s, and we support smallholder farmers typically with 2 or less hectares, all different aspects: infrastructure, market access, finance, value chain development. And since the late 1970s, we've invested around $4 billion in financial institutions and financial service sector. And our current portfolio has about $1.1 billion in that kind of investment around the world. So we've learned a lot over the last few years, and we know that it's very difficult to do inclusive finance. Inclusive green finance is just one more step, one more challenging step forward. And so what we've done over the last couple of years is really try to figure out what the generalized trends are for financing of this kind of activity, starting at a very general level and working our way down to the smallholders, and then working our way through to how do you actually finance them? Because while there are spotty activities around the world, we haven't seen this being done systematically, unfortunately, yet. Adaptation and mitigation finance for smallholders around the world. And we know that the European platform, and we know that groups like Yahoo and the Just Institute are forging ahead and have a long history in doing some really great stuff. And we're building off of your guys' shoulders. So a shout out to you right at the top. And we're working hard to figure out how we do this in an institution like IFAD on a more systematic basis. And I think we've made some very incredible and interesting headways. I'd like to start by looking at a very general level. I'll go through the next slides fairly quickly. Can we go to the next slide, please? So the total climate finance flows over the last decade have actually been increasing, but the rate of increase is slowing. Obviously, that's from COVID and the Ukrainian war crisis. Money's being diverted in other areas. That's a little bit dangerous for us. Obviously, we'd like to see that rate go up. Next slide, please. Yeah, and that's the gap. That's why we need it to go up. That's what that top line is, what we should be financing. The bottom line is what we are financing, and that's from all sources. I'll disaggregate that. Okay, next slide. Yeah, so climate finance needs for agriculture, forestry, and other related land uses, AFOLU. And you can see here the UNEP estimates annual adaptation needs in developing economies is around 330 billion at the top end by 2030, which David kindly reminded us is tomorrow. And after that, even more, up to $500 billion a year. And that's a lot of money. And you can see in the pie chart to the side, agriculture is a big chunk of that. Infrastructure is another big chunk of that. But agriculture is the biggest. And it's a huge issue, particularly when you remember in most developing countries, food security is directly related to smallholder production. Over 70% of the food consumed in most countries comes from smallholders. And you know, you sit at your table sometimes and you see food from developing countries as well. So we have to talk about food systems and security. It's going to take 1.3 trillion estimated investment every year over the next 3 decades to make sure our food systems transform in a way that we can survive and they can survive and thrive under climate change. This is not just a climate issue. This is a justice issue. This got all wrapped up in global migration patterns, national and international migration, job access, all these kinds of things. So this is a fundamentally important issue. Next slide, please. For climate finance, the small scale ag sector, you can see here 95% of it is provided by public international financial flows, most of it grants, some concessional debt, some non-concessional debt. And we can see here that there's a variety of uses: capacity building, de-risking, first loss tranches. Although I would say that de-risking is a lot less than capacity building and knowledge gap bridging. So public actors are investing, and they're absolutely fundamental to what? They're fundamental to stimulating and catalyzing new market development, which, by the way, is part of IFAD's almost still new inclusive rural finance policy, which was published in about a year ago now, stimulating and catalyzing, using our money to do that. So next slide. So where does the money go? Climate finance to small scale agriculture. You see it. Adaptation takes the lion's share at 49%. Mitigation with 22%, and then sort of crossover dual objectives in the middle at 29%. And this kind of reflects the increased vulnerability of small scale producers and rural poor, because they have to adapt to climate change. They're seeing on the ground changes every year, and they have to adapt. So this is, and IFAD, our climate finance adaptation to mitigation ratio is 90-10, which is the opposite, by the way, of what finance in general is doing. So next slide, please. Let's break this down a little bit more. Where is the financing going? What is it actually doing? You can see that low carbon climate resilient infrastructure takes the lion's share at 36%, followed by improved agricultural production and livelihood of rural communities. That's in the bottom left, 14% each. Take a look at the bottom right and see 4%. This is what we're real interested in, is at 4% of climate finance, the small scale agriculture sector is channeled through domestic financial institutions as intermediaries to facilitate credit lines and improve access to finance for small scale producers and value chain actors, including SMEs. And this is really key, because if you go back to if you think back to the slide before, you know, what are we developing here? We're really leveraging and financing, we're leveraging a lot of change throughout this graph, rather. So we're leveraging a lot of what's going on. And this is really important to remember. Next slide, please. Adaptation finance, where is it coming from? Well, all the blue is public sector of one type or another. You can see the amounts on the side, go through it, but most of it is from public sector, almost 100%, in fact. And if you look down to the bottom right of the blocks, you see that corporations, so this would be internal investments from corporations, and institutional investors put about $1 billion in a year, which is not a lot at all. And we need to get that amount up, because as I mentioned earlier, the more we can get investors to invest, the more we get leverage for change throughout the adaptation and mitigation investments. Okay, next slide. So to recap the key messages of this broad picture of where climate finance is coming from, the level of investment is clearly not up to the needs that we have, which are run to the hundreds of billions annually. The funding gap for the sector is large, as we saw, and it's going to get bigger probably. But we have some hope. There's some blended finance and private sector engagement investments and mechanisms taking up scale. It's slow. You saw it. It's about 4% of the overall investments going into the area. And growing climate risk requires step change in ambition. And that's certainly what we want to try and do at IFAD. We're working hard to try and figure out how to get more money into the system and how to get more money out of the end of the pipe at the retail level. And what I want to do next is really take a look at some work that we've been doing in design. I want to emphasize this is design, okay? And we've learned a heck of a lot by trying to do really demand-driven market building. And that's part of our new rural finance policy as well. So smallholder adaptation finance market development, but from a people first perspective, from a demand perspective, because if the smallholders are not going to make the investments and not be able to do it sustainably, we don't have a market. Doesn't matter what you do. So we don't focus first on the financial institutions, we focus first on demand. And I want to share some lessons learned from designing a regional, inclusive, low emission and climate resilient agriculture smallholder finance program. We're designing several of them right now. The one I'm going to refer to is called IGREEFIN 2, and I'll explain a little bit more in a second on that. Next slide, please. So smallholders, you know, well, what we know, first of all, is that we have to start by saying there's limited interest on the part of financial institutions for inclusive rural and agricultural lending, let alone inclusive green agricultural lending. Smallholders, why? It's a familiar story. Smallholders and finance are perceived as risky. Financing them is risky. And it is. And there are levels of real and perceived risk. And the risk is not insoluble, but there's substantial risk nonetheless. And we have to deal with that, right? And the second thing is some financial institutions are actually doing climate finance. Many don't know it. So we have to understand what they're doing and figure that out. And so some are more doing, mitigation or renewable energy technology kind of things like solar pumps, solar lighting, these kinds of things, solar power, solar fridges, and that reduces emissions and really helps farmers in doing a lot of their work. But we're focused a little bit more on lending for climate adaptation, which is a little bit harder. The techniques and technologies that help adapt production to climate change and make food systems more resilient to change. And again, adaptation technologies lending is not going to take a little second still there, David. Lending done necessarily it's not done always on a recognized basis by financial institutions. As I mentioned, drip irrigation, banana pits, shade trees are all being financed by financial institutions through asset loans to smallholders. Now, there's also a lack of green finance market potential, or at least that's the perception. But like all new markets, there is substantial potential. The question is, how do we stimulate existing and expand potential new markets? And there is finally a lack of green finance know-how, despite the repository of knowledge that European Platform and others have brought together, including ourselves. But it's still not widespread. We still have lots of questions that get asked over and over and over again. I've been in this inclusive finance for 20 years, and I still get questions about basics of inclusive finance, let alone green finance. So what we want to figure out is, where is the market? Like targeting those who'd be willing to borrow for financing for green finance investments, and then understand underlying credit risk and climate needs in order to be able to design and offer lending products on a sustainable basis. Now, there is a difference, obviously, between inclusive finance and inclusive green finance, and that's what I want to try and get into here. So the three main challenges that need to be overcome is, we need to demonstrate, to get the money flowing, we need to demonstrate a financial rationale for smallholders to invest in green finance and adaptive technologies. We have to demonstrate there's market potential, and we have to demonstrate loan product viability. And I want to take each one in turn. And I'm going to use examples from IGREEFIN 2, which is a regional project in 7 countries along the Great Green Wall in Africa. And we've learned a lot from our design activities and trying to figure out what smallholders would be interested in borrowing for and how financial institutions could do that. So how do we demonstrate market viability? Next slide. Okay. So this is from Nigeria, but we did this analysis in 7 countries. In addition to doing focus group works for market stakeholders in all countries, we also did a digital demand survey. We did that in Ethiopia, Sudan, and Nigeria, first time ever. And this is some of the results that we've got from that digital demand survey. It's not the only thing that we're using in the design. Like I mentioned, we complement it with focus group work, but this is really important data that we're getting. So the first thing we have to do is understand household economics and finance, household incomes and household investments. So for income, specifically, do or can farmers generate income sufficient to make the larger investments, take the larger loans in climate assets, climate resilient assets on the farm, in addition to the working capital loans they usually take every year, and some consumer loans they're going to carry. So does the household have the capacity to take a loan? And then household investments. Are they willing and are they interested in taking a green loan? And if you look at the pie charts there, you'll see that 73% of the farmers making over $1,000, that's US, make enough income to possibly support a well-designed green loan fund. So I'm taking the 43 and 31% there. And that's enough to take, and you'll see some of the loans that we are contemplating in a future slide here. And then we also find on the right there, 44 and 14% are interested in making on and off-farm business, taking on and off-farm business loans. So there is a market, at least at a very general level. So let's take a look at the next slide. Now, demonstrate financial rationale. We're going to continue to do that for the smallholders. Their willingness to take a loan, categorized here by desire of level of additional income that they would need to take a risk, to take a loan. And you can see in the first chart, it's a very small amount. It's like $20, $30 rather. And the second chart, it's 30,000. So it's $70 or $80. And then the final one is $250. So we see over the progression of charts that the smallholder farmers would be more willing to take a loan for a smaller risk, for a smaller return, but still a significant number, almost 40%, would be willing to take a fairly large loan to get $100K or a $250 return on their investment. Now, sorry, can you just go back for a second? Now, take a look at the bottom. 42% of those surveyed, however, said they had lack of funds to make investments. So that's a good thing, obviously, from a borrowing perspective or a lending perspective. But 33% also lack the information on available technologies for climate adaptation as major barriers. So these are two major barriers. So lack of capital, lack of information. And that's something that organizations like IFAD can actually solve. So they need technical support for financing, or they feel like they do. Okay, so next slide. From this, we can generalize assumptions about market size. This is typically what you would see in any one of our designs, but we're not building it off of, normally building it off of such detailed data. And I skipped a lot of data that we collected for coming up with these assumptions. But if there are 33 million rural poor smallholder farmers in Nigeria, and of these 33% have sufficient capacity to take a green loan, that's about 11 million potential loans. And of these 80% willing to take adaptation mitigation loan, about 8 million smallholders. And if they take an average loan of about $940 or 400,000 Nigerian, which is about the average cost of the green types of loans, you'd see the market is around 8.8 billion USD. Now, even if we're off by a factor of 5 or 6, that's still a substantial market, but it only gets us halfway there to understanding what we need to do to create the market. Now, climate analysis about what climate technologies are affordable and what are going to give the returns to the smallholders is what we have to figure out next. What's going to improve their resilience and increase their income. And it requires some serious number crunching to assess financeability of climate tech. And here's where we start deviating from the standard sort of approach to inclusive finance. So next slide, please. And give me a bit of a break on this. I am not a climate expert, and I hope that I can represent my colleagues well in this, because they've done an incredible amount of work to figure things out for us. But anyways, the market analysis for the climate side, we have to have consistent and continuous, which means obviously updating our data all the time based on climate change information as it comes into the data sets that we access. But for climate and hydrological analysis, what's the risk to the particular commodity? And then finally, what are the prioritized adaptation categories or technologies and options that the smallholders can use? So at the most general level, that's what we're trying to do. So next slide, please. So here, no, you went too far down. So adaptation categories and options. I don't want to go through the long list, but there's a long list. There's like 150, in fact, applicable adaptation activities that a smallholder farmer can take in and across the Great Green Wall countries that we're looking at for IGREEFIN 2. And soil covering, improved irrigation, windbreaking, micro-harvesting, shading, shade houses. These are examples. And so if you take a look to the top right, you see crop variety shifting. So it shifts over time what kinds of crops should be used based on the climate analysis. And that's the middle part on the right-hand side. What's the climate information that's driving the modeling? And then down at the bottom, what's the risk transfer? Where were the risks within the model that we're looking at? So those are some examples, and I'll get to some specifics in a second. Next slide. So this is hard to read, and I apologize, but this is really hard stuff to understand for me, and I'll try my best to explain it to you. Basically, what we do is we take all the climate variability data that we have, and we apply it to a specific crop, right? And then we look into the future, and we see what's the risk. We look at it 1 year, 5 years, 10 years, 15 years, because we want to understand what's the financeability of a particular asset, and the asset's supposed to last over a certain number of years. And then what we can do with that, we can actually get internal rate of return and net present value estimate on the investment itself, based on standardized size, and then we look at the volatility of yield over time, right? And then we can do a net present value of what that investment should yield you if you're going to make the investment today. Okay, so the example that we have here is millet in Nigeria, and what our analysis showed that without robust adaptation, crop yields are projected to decrease up to 20% over the next 20 to 30 years, right? And we find that many simple adaptation technologies can counteract this decline, increase incomes, sometimes up to 50% or more. Okay, so let's take a look at this graph. So gradation and duration. So we've divided our gradation and duration into 3 categories: commercial banks, which are not shown, microfinance institutions, and subsidized. Microfinance institutions on general in Nigeria are charging about 24%. That's their rate to make money. They have high transaction costs, they have high capital costs, and so that's what they need to make money at. Now, we know we can get them lower through digital finance and digital technologies, but we're just taking their base return interest rate right now. And we go to 1 year, and we see if you take a 1-year loan for $340 on a thin crop residue banana pit, that's soil conservation and water conservation techniques, you'll get a 53.5% return on a $340 investment. That's well and above the 24% the microfinance institution has to make. So you can make that loan. And you go across and you take a look at the different examples, and you can see they get a little bit more complex, a little bit more expensive, et cetera, but the returns are all positive on the top. You see that. But if you look down at the bottom, you see subsidized rates. You see some different technologies. Windbreaker Half Moon, for example, $420 investment over 3 years, you're getting 13.9%. You can't do that from a microfinance institution that requires 24%. So you have to subsidize it. Subsidizing the market is not necessarily bad if you're creating a sustainable market in the future. So we have to make those kinds of analysis and adjustments when we go in and say, we're going to do this big program to try to stimulate the market. Where do we want to go? We probably want to be somewhere in the middle where we're going to subsidize a little bit, perhaps, maybe with technical assistance, as noted. But you can see here, we've done our analysis. And if you look to the far right, you see the simulation is based on about 2,900 individual and packages of adaptation options. So we're not just doing 1 or 2. This is big number stuff. And we're producing all the different, real-time financeability analysis that we need. And it's real time. You can update these models every day. Let's go to the next slide. That's how it looks when we chart it out on net present value and internal rates of return. And we can see that if you subsidize one, it's just above, and if you don't subsidize, it's above too. So you can, without investment grant, with investment grant. Investment grants are important. What are they typically? They can be just simple TA to help de-risk, ensure that the application is going to yield maximum returns, or it can be a matching grant to lower the asset cost and lower the risk to both the financial institution, but more importantly, to the smallholder. There's no point in putting the smallholder into debt just to raise their income, and they can't repay it. That's ridiculous, right? So this is just how it looks in the end for a windbreaker 100-gram half moon for maturity of 1, 3, and 5 years. So we can tell you within this kind of precision what kind of investment is actually going to make sense for the smallholder. And just so you know, it's coverage. The weight is coverage for wind and radiation protection of the crops. Okay, next slide. So what we do after we get that analysis, we go back to our demand and supply analysis, and we can understand with some precision what kind of product or service is going to be required to make the loan for the windbreak, to make the loan for the banana pit. We're going to be able to say what's the term we're going to have to use, what the rate can be, how can we finance the financial institution to do that, and we can stimulate market through with a viable loan product. So here, just to summarize, and I'm almost done, so bear with me just for a moment. The main agricultural activities and climate vulnerabilities are assessed. We project climate variability and impact production and farmer income. We take a look at the available technologies, prioritized by their net present value and internal rates of return. Then we look at the financial potential for the adaptation technology. And then we say, you know, can the financial institutions provide the credit given their operating and financing cost structures? What's the segment look like by adaptation type? What's bigger, banana pits or wind or shade cover? What are the 5 big ones we can finance, and can we have a product or service that can look at all of them at the same time? And then we design a product. And we're not there yet in our design, and we won't get there. We're going to leave that up to the teams on the ground in a startup pilot phase for each of the 7 countries. And that's our idea. So to conclude, we need more financing. It's not coming from the private sector. Developing inclusive agricultural smallholder products is not that much different from any other inclusive ag product, with the exception of this incredibly potent and precise climate volatility analysis on yield and incomes. And we feel like we've made some major strides forward in doing this and learned a lot of great lessons. And I'm sorry I went so quick, but I wanted to leave as much time for answers and questions. And again, you know, I'm a finance guy, not so much a climate person. And I'll do my best to answer any questions along those lines. Thank you very much for your attention.
So thanks a lot, Mark, for this, I would say, great presentation and inspiring. I very much also appreciate, and I think it's totally aligned to what we do here in the Green Inclusive and Climate Smart Finance Action Group, to see green inclusive finance, because it is inclusive with the focal point of decreasing vulnerability and building resiliences, because we cannot imagine a green transition when we put green and inclusive without generating resiliences, without focusing to adaptation, because the people that financial institutions want to finance or are able to finance are unfortunately among the ones that are among the most exposed today to climate change and many other issues, and will be more and more exposed. So in adaptation finance as also as an engine for mitigation, as well as a focus for just transition, like access to food, etc., I think is totally keen. So we are so proud that IFAD is totally aligned to what also many other of our members. So, and we see so much possible synergies and leveraging there. So please don't be shy. Post your question and into the chat and into the question and answer. Please also, we can also give you the mic if you want to intervene. You could also share your view on what you have been doing or what you have been trying to do. It has been work or not into this key topic, into adaptation, as well as into agricultural finance. I will maybe start eventually breaking the ice by asking one question that maybe you have been asked to yourself and to your colleague many times, and it is, so why the private sector is not financing resiliences, is not financing adaptation? Is it because it is not ready yet? It is because it is not their market today and neither tomorrow, or because there is not still enough, capacity to assess that if you build resiliencies, also your investment will be less risky. So what are the key reasons? Do we need to reach a certain amount of public finance and a certain amount of capacity, and then the private sector will crowd in? Or what's the key challenge you see there, and how to solve it?
Thanks, David, for that. So why, the question, I guess, is why the private sector is not coming in. Personally, I've been working in impact investment long before it was called impact investment. Right? It was called ethical investment, then it was social investment, then it was sustainable and responsible investment. Now it's impact investment. And I think we're getting closer and closer to the truth. The reason why is that, the reason why I feel is, the profit motive will follow where the money goes, and transaction costs and potential margins are really what banks are still looking for, right? And we've talked with some of the most advanced financial institutions in this area, and they still put, this kind of finance in their corporate social responsibility bucket, right? So that it's a toy. It's not real. And until it gets on their balance sheets, forget about it, right? And we have to look at the opportunity costs of their internal financing, right? What are they going to invest in? This is very difficult to convince them to invest in. And, I take the example, just quickly, Goldman Sachs or JP Morgan, I can't remember which, made $100 million investment in Detroit in community development. And it was a big thing for a long time in the United States. That $100 million was $900 million less than the bonuses that they paid, like their top executives. I'm not even talking about their other executives, okay? So until we can convince the major financial institutions this is financeable, we don't have a game. We're just going to be stuck in that other bucket. And we have to get out of that bucket. And the way we're getting out of that bucket is the same way we've done it before. We're proving the case on the ground with the institutions that are willing to go there. Which are the institutions? Smaller, less strong, undercapitalized, not having the technical ability, but they're willing to go there. So I would say what we need to do is get, some medium-sized, public development banks that function well. We have to get, the bigger financial cooperatives. We need to get the bigger microfinance institutions, et cetera, to play ball. And I will end by saying this. We have a new program that's called, that's being designed as well. It's based off of all the thinking that we've learned from this IGREEFIN stuff. It's called ARCAFIN. And they're going to involve two major regional banks in East and Southern Africa. And we're going to leverage in some serious private capital. And that's using blended capital finance approach with, we're making the proposal to the Green Climate Fund. And if all things work out the way we will, we'll be leveraging in probably the biggest chunk of adaptation and mitigation finance to smallholders at one time ever. So we're really looking forward to that. And we're talking with lots of catalytic investors in other regions to do the same. So I think that we know how to do this. We've done this with inclusive finance. We just keep marching along and doing what we do. Over.
Thanks a lot, Mark, and thanks for the inspiration that is gonna grow, and that is your mandate. So here we are, Peter Zetterli, that is first of all greeting you. Hi, Mark. This is Peter from SIGAP. It's a great work and good insights, and one of the questions that you have partially started answering is what are the next steps for this? So repeat the analysis in other market, adaptation packages, plus mobilizing public finance to mobilize through de-risking private capital to scale up supply side. Is that the path you see as a consequence of what we've been doing so far? Or do you see other next steps?
Yeah, where do I see the question? I don't see the oh, there it is.
It's in a Q&A.
Okay. Yeah, okay, perfect.
Q&A.
Okay, I got it. Yeah, I got it. Thanks, Peter. What are the next steps from this? Well, I think I sort of mentioned that. And you guys at SIGAP, I'm so glad last year you put it in or 2 years ago, you really recognized the climate and green finance as fundamental to your mandate, and we need you helping on all gears. I mean, there's some real policy stuff that needs to take place, which I haven't mentioned as well. And I can talk a little bit about that later maybe, but adaptation packages, mobilize public. Yeah, I think you're right. We need to have public finance being catalytic. I mean, purposely catalytic. If you're just going in and you're not going to leverage a bunch of private capital money, there's no point. We don't have time. David, you're right. It's tomorrow. 2:30 is tomorrow. 2:50 is next week. And we need to leverage in the money now, because, for every dollar that, the private sector can put in, we can see 5 to 7, even higher leveraging rates, right? And most of that's from private financial institutions. But what I would like to say is we need to figure out, we need to crack the
impact investor nut as well, because they too are tiered. And it's really important to remember that we have our real friends like IncoFin and others that are, and Root Capital, and these kinds of funds that are making investments already. They get us, right? They know us, and they're going to, it's easier for them to make the next step than it is anybody else. But then there's a second tier and a third tier of impact investors, which, you know, the second tier is like people with just gobs of money. A lot of them are high net worth individuals that are just thinking about doing this. But then there's the next tier with the foundations. They can make program related investments. And then there's the next tier is where we really need to get. We have to be able to convince the Goldman Sachs of the world to not spend quite so much on their bonuses and make the investments, because that's the kind of credibility structure that we need to really open up the floodgates. But before that happens, we have to prove a lot more stuff on the ground. Like just recently, we asked all our financial experts in IFAD to come up with a bunch of examples on the ground of green financing, the way we see it, you know, really working and helping the smallholders. We didn't have a lot, you know, that was done purposely. And so we're going to change that, and we're going to do a lot more of it in the future. And I hope pioneer some real areas. One thing I would say is something that, and I don't mean this to butter your bread, David, but you know, the work that you're doing with BNP Paribas and the Just Institute to try and certify the level of, or verify the level of greenness within a financial institution's portfolio is super important work. I know from my work in sustainable and responsible investment for, you know, big investment companies, like we need to have that so that they can report back to their stakeholders and say, with this level of confidence I have, because it's certified, bring your money, please. And we know this one fact from this kind of investment is people who are given the option in their pension funds to dedicate a small portion of their investments to this kind of investment, not necessarily this kind, but, you know, green, helpful, just kind of investments, you know, it's almost over 30 or 40%, depending on, you know, where they're coming from. That's trillions of dollars, right? So we have to get there. And the way we do that is transparency and proving our case. So that's one thing. And at the other side, Peter, and I'll finish with this, is that we really need to understand how to do good credit, climate credit risk management. And that's fundamentally important, because if we can't make good loans that help the smallholders, that create sustainable markets, we might as well pack it up and just throw money out of a plane, because that's what's going to be necessary. Proving it at both ends with transparency everywhere, it's a big task. But I mean, we've done this inclusive rural finance. We've already done it. Let's do it again.
Thanks a lot, Mark. And yeah, I also want to react before giving the word to Armando. You say something that's really moved my attention when you say many financial intermediary institutions are already financing things that are for adaptation, but we just don't know, and they just don't know. And sometimes also the final user don't know it. Yeah? And so when we used to have a classical approach toward adaptation finance, but also green finance, we start arriving to the market and say, hey guys, you need to finance this stuff. Well, now I see that's a bit changing. I don't think is enough, but to really identify what is already done, that somehow means that you're willing to do, and somehow means there is already demand to do, and then building out of that, you know, to then improve it, you know, technify it, and then focus the finance, as you were mentioning, to the project we will do together with the Just Institute, IFAD, and BNP Paribas, for example, through certification. So we analyze what is already there and then try to channel private and public money to what is adaptation, I think is key. And sometimes the effort is not so big as we would imagine, because from years and years of experience, there is already adaptation into the portfolio. Just we don't see, or we don't see it, we don't focus into that. And so we focus just on the other side and say, if we maybe focus on what is there, what other people already see as an opportunity, it's really easier as a starting point. So Armando Cortes is asking us, hello, James. Thank you for the presentation and showing us more about the IGREEFIN study. My question is, does IGREEFIN compare the profitability between the same crops, as it might change between region and countries, and shall this kind of study should focus on cash or staple crops? Thank you.
That is an awesome and somewhat complex question, Armando, and I'm happy to see how I can answer it. IGREEFIN is a design analysis for the supply and demand of green products, which includes climate volatility and effect on productivity and yields over time. Yeah, we actually look at the same crops within different regions. One of the things that we do a little bit differently in this, and we're not sure how we're going to present this because it can cause some problems. Typically, we think in terms of countries, right? Well, the environment or ecology doesn't think in terms of countries. It thinks in terms of, habitats, ecologies. I might not be using the right words, but so what we're trying to do is look at crops within certain ecological zones. Okay, and we've actually, the data that we have goes down to 20 km squared, right? And so that's not high resolution given some microclimates, but it's as low as we can get. The data for, we'd burn up a bunch of computers if we went to a smaller resolution. And so, yeah, I mean, we'll look at millet, corn, sorghum, some of the bigger crops that go right across that band, but we'll be using different data, right? To understand the volatility of climate effect on productivity and yield. So we're mostly focused on ecological zones, I guess, if that's the right word. And so I like your question a lot, Armando, the last part, cash or staple crops, because one of the things that we want to make sure at IFAD is that people don't get into the situation where they're just selling everything for cash, right? And we want to make sure that they have sustenance. And so in many of our programs, we have a backyard garden components to it, so that we encourage stakeholders in the programs to actually do backyard gardens, so that it improves their nutrition and improves their food security at the individual level and community level. And this is really important for us because nutrition and is actually a mainstreaming issue for us. So thanks for the question.
Thanks a lot, Mark. Peter, so he's asking us, to your point about improving climate risk management, do you see a risk that if the inclusive finance sector does not get better at this, they will over time be forced to exit certain geographical area and value chain as the climate risk grows? I mean, that beyond the opportunity to help clients to adapt to climate change, this is ultimately also an existential question for financial inclusion mission.
Peter, any question that has existential in it makes me ponder and worry. 5 years ago, we weren't seeing that much impact of climate change. You think back 5 years ago, the odd hurricane or the odd, event, climate event, and now we're seeing it like it's constant, right? Wildfires, flash floods, long floods. It's just constant. So yes, if we don't deal with this quickly, there will be certain areas that are absolutely not profitably inhabitable or sustainably inhabitable. And that's why we're working on the Great Green Wall, because the advance of the Sahara Desert is causing great, I don't know if this is still the most current statistic, but I heard a while ago that, it's 10 kilometers a year, it's advancing. And people live there. I mean, I've been to northern Nigeria, and you can see the impact. And so instead of just planting trees, we're hoping that we can do all sorts of adaptation technologies that will actually help improve the environment and improve livelihoods at the same time, that are financeable. And that's why the degree of precision that's required to make sure that we're responsibly advising smallholders to invest their precious pennies and dollars in a way that doesn't put them at even greater risk. So this is an existential financing question, if there is such a thing. And I think for financial inclusion institutions on the front lines in those areas, yeah, it's existential. But I also think in urban areas, and I think in some, in quasi-urban areas, it's going to be important as well, because there's going to be massive out migration from rural areas if we don't do something. So even there's some, real issues of bulking up our ability to finance people who are coming to urban areas.
Thanks a lot, Mark. Thanks, Peter, for having asked this question, and thanks also for having pointed out. I think the connectivity between agriculture and urban area, as well as we see with the event nowadays, the connectivity we have worldwide. If you just think how price can increase because there is an issue in one part of the globe, how that could influence everywhere and gets typically on the shoulder of the most vulnerable one. So there are studies that, of course, show that a huge amount of trillions are dependent on nature, and that does not mean it is your own nature. It could be the nature of someone else, but you're buying products from this nature somewhere, or you are not buying, but you're buying things that are related to that. So your price will keep on increasing. So nowadays, I really think we need to crack the nut that we have been building for a while, that is really thinking in silos, because to improve efficiency, we just look into one sector, into one place, to one chain, etc. The climate change and biodiversity losses, I think, remind us that that are just interconnected, and if not, you can just close your eyes and isolate someone. So maybe, yeah, just building on your point, Mark, and to give you back the words. I really
we have another question, that's all.
Yeah, I get it. I saw it.
Okay, sorry.
No, I was just saying that it is also no more. I mean, there will be this risk coming, as you're asking, that some places and some region could be excluded, or some population, but because that scam is going so fast and it's so much interconnected, is that will have huge repercussion also on parts that are far away from the the locality and the value chain that is hidden by climate change. So somehow we cannot avoid to finance there, because we'll have other repercussions. That's at least my feeling. So hi, Diana Klaus from Oiko Credit, an impact investor. We are very interested in investing in long-term financing of climate adaptation and mitigation, especially carbon financing for smallholder farmer cooperatives. Or cooperatives. So far, the risk of medium long-term financing smallholder farmer are significant. The risk in those investments is the only way to get them into the balance sheet, as opposite to CRM initiatives, as you mentioned. Does IFAD or any other institution provide subsidies or similar de-risking initiatives to support financial service provider in breaking the ice and taking the risk?
Yeah, Diana, this is a really good question, and one we deal with on a regular basis, because we do a lot of line of credits, sovereign lines of credit, and oftentimes it's difficult to get those lines of credit to stimulate the outcomes that we want with the financial service providers, for a bunch of different reasons. A lower or friendlier terms is often just not enough, and we have to figure out how to de-risk the market a little bit better. And the typical ways we do it, obviously, the first way is through our program of activities. They're sovereign loans, so they're managed by the national government. But we provide technical assistance to smallholder farmers on the kinds of activities that are going to increase their yields and incomes, and increase their resilience to climate change. And that's one of the key things, if there's a technology that they need, and they can borrow for that technology. Matching grants are sometimes used, as I mentioned earlier, to reduce the overall cost of the investment. They work to varying degrees as well. They're a little bit harder to organize and et cetera, et cetera. We're coming out with a knowledge product on both matching grants and lines of credit in the near future, not just focused on green, but there'll be green focus on them. And then there's guarantee mechanisms. There is, sort of smaller ones, like we're going to hopefully pilot in the NEN region, my region, soon, META region, to do a contract where our line of credit takes a junior position on a loan to a microfinance institution. We hope to get a commercial bank to take the senior portion. And then we can actually make that contract a public good so that financial institutions can do that. And we can use our line of credit to leverage a private capital. This is in place of doing a credit guarantee mechanism. They're more difficult to establish, and they have all sorts of their own problems. But sometimes countries will have them set up, and they can work well. So that's another way to de-risk. And then finally, on your last part of the question, breaking ice. Yeah. Okay, I think I've answered most of the question, but I just want to do a shout out to Oiko. I've known you guys for a long, long time, and I think you do great work and really important work. So if you want to connect on what we might be able to do together, that'd be great. One last point I did want to bring up is that in our work, we see farmer organizations, co-ops, and such as aggregators. They can bring markets together. Two, they can distribute products and services and make some money that way, and then they can also provide services themselves. One thing I want to note is that their data is valuable, and so we want to see how we can mine that data value. And then finally, I would say on the carbon market front is I'm not that well versed on what's happening at IFAD with that, but I know we've got a lot of activities going on. But the key here is to get the money back to the smallholder. So actually, if you're a smallholder and you're doing something that's mitigating, why don't you get the environmental service credit for that and the money? And so we're looking at digital technologies, particularly to decrease the transaction cost, and using blockchain to make sure that that the farmer is getting their due. So she's able to get what her mitigation efforts are actually producing.
Thanks a lot, Mark. I think we are over time, but I will just take the last question if you're fine with that, and then we close. So first of all, Diana is clearly saying thank you. Please, if you need a partner for a pilot, I would be happy to be in touch. So just if you have not seen that, and then John is telling us a good point, Diana, connecting the dots between ERR of resilience technology, real risk of mitigation, and the fact that agri in the north is highly subsidized. Should not much more subsidies exist for population most being impacted by climate change? Are there not plans to provide serious subsidy scheme to accelerate investment in resilience? And then
that's a really great question, John. And the way I would answer this is to go back to our inclusive rural finance policy. The first policy that we had dated 2009 sort of said, we're not going to distort markets. We have to go market price. And that's very important. But our new policy gives us more flexibility in saying we have to create sustainable markets. And we have to demonstrate that what we do will do that, but it doesn't have to do that immediately. We know that in many, many, many markets, governments have fully subsidized everything from startup right through to scaling, and even some commercial activities when they don't even need it. But this is fundamentally important. But the question is where do we use our precious dollars? And where do we use our precious dollars to catalyze real change? And we're placing some bets on certification and verification. We're placing some bets on credit risk methodology. We're placing some bets in challenge funds. So we just did a recent design in Palestine. It's not approved, it's just the design, but it's a challenge fund. And one window will be for climate finance. Another window will be for digital finance. And so we hope that we'll get a digital green. That would be the best of everything, right? And so we have to place our bets very, very carefully. So that's why organizations like CGAP are fundamentally important to providing the overview, providing the direction, providing the policy recommendations of how and where we should be investing well. And a lot of other institutions, I know the platform as well is very important in helping and having these sessions. We're at a really critical moment. We don't have a lot of time to replicate what took us 30 years in inclusive finance. We have 5, 6, 7 years, and we can have a big impact because we've already learned. So that would be my message to close, is that we have a lot of really powerful people, really smart people, great institutions. We've done this before. We can do it again. Forward.
With that, Mark, and with these inspiring words, I will not know what to add more. So I would like to thank everyone, remind you that you will be able to find the registration of this video if you want to share with your colleagues into the website of the action group that you find downstairs there into the middle of this last screen, as well as the material that you have seen. You will find that you can download, as well as other experiences and other opportunity to get engaged. I would really like to thank, first of all, every one of you that's joining this webinar, the one that are here for many times and the one that joined for the first time, to ask for your colleagues to get engaged into that and into the transition. And I would really like to thank Mark for your inspiring work and for the work that IFAD is doing. And I very much know that the door are open to everyone to join, because the key point is to push a just transition. So guys, we meet you to the next webinar, and keep on adapting, because it's very much needed.
Okay,
Thanks a lot to everyone. We see you next time. Thanks, Mark.
thanks, David. Bye.
Bye.